My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. Now, I was away last week at the Commodity Trading Week online conference, one of the largest conferences of its kind, so I'm actually glad to be back and seeing that there have been some interesting moves going on. My phrase, beans in the teens. Yeah, beans in the teens, but barely. Last week was a seminal week in many ways. When you have a week with a consecutive countering action to the fourth level, as we did on Wednesday last week, you know that something is not right. That is way too much intraday indecision to be healthy in any market. Additionally, and this is an observation I want to highlight, last week was not a key reversal, a weekly key reversal down. It was not so by only half a US cent. That's it, half a cent. It ended up being a lesser but still bearish outside week. So bearish as last week was, after all the indecisive days at the beginning of the week, it was only this week that we saw the full outcome of that struggle for control. The move back down through the old 1459, 1467 gap from May 2014, that happened on Monday, something the market could not manage to do back in May, and the close below the almost flatlining medium moving average, currently at 1445. That really cemented the start. Then yesterday's push down through and closed below both the 2021 uptrend, currently at 1421, and the recent 50% Fibonacci line at 1405, further added to the bearish incentive. Today we have carried on lower through the target X in the 1353 area, the potential target for the May high to date bearish halfway hesitation. There is one other feature, and a major feature, that I need now to discuss. You may recall that over the last few weeks I've been talking about the possibility of a large pattern, a bearish bump and run reversal top, formed throughout 2021 so far. Now, I qualified this last time by adding, and I quote, but it is early as yet on this idea. It will very much depend on the market reaching the lower bull channel line and on what it did once it managed to get there, if at all. So how does this affect what we are seeing now? Well, as I said 2 weeks ago, and I quote again, so why am I still talking about this bearish bump and run reversal top? Well, it very much depends on the recent action. The indecisive spinning tops either side of last week, and that's 2 weeks ago, even if they drove the market higher, and today's action of the market seemingly being reluctant to push up over the 2014 high of 1522, the bearish bump and run reversal top still resonates with me, especially the hesitating where the pullback has moved back up. I would suggest looking closely for one more week and seeing what the market says in the meantime. I say that was 2 weeks ago, and you can now see why that resonated with me. So let's look at possibilities going forward. If this bump and run reversal top holds true, which so far it seems to be doing so, then an estimate of the full move low will be down to the 1297 area. This is interesting, as that would tie in with the rising long moving average right now, currently also 1297, as well as the 2021 low formed in January. The long moving average would probably be higher by the time the market gets there, if it does, but not appreciably so. The current rate of descent is maintained. This is not a done deal, but as I said before, this bearish pattern resonates with me. Finally, just be aware of the new May to June bearish Andrews pitchfork I've drawn. The pattern has not been properly tested, but prices are now just diving below the middle time, currently at 1371. Chicago soybean meal. So we finished May with a monthly key reversal down. A pattern you'd not expect an immediate follow-on lower to in June, as the timescale of such a pattern is so large. And so at the start of June it very much looked like a possible pullback up from the bearish we'd seen in late May. However, please note that this market has dipped down and closed below the long moving average, currently at 397.30, with a huge bearish immediate countering combined key reversal down and bearish engulfing pattern. And that was on Monday of last week. I actually thought we might see some basing action off the long moving average as we did back in late May, but the single day's bearish action put paid to that. There's only been the old December 2020 lows around the important 50% Fibonacci line of also the important August 2020 to January 2021 move that we've seen any reactionary move back up, with a key reversal up yesterday. However, the high of yesterday ran into the key bearish pressure since May, the May to date downtrend currently at 380.10. It is such that the market is getting squished between this downtrend and the earlier mentioned 50% Fibonacci line. This ought not to last long, as whichever is dominant should surface by the weekend. There are two further things I'd like to add. The first is something I've been contemplating for a few weeks now, bearish pitchfork. I've chosen now to go with the bearish 2021 Andrews pitchfork. Currently the market is in between the middle time, currently 392.5, and the lower time, currently 346.20. Right now it looks like the middle time may have some pedigree as a rolling and lowering resistance. The next is a little bit unsure and a little bit out there, but I'd rather say it looks a fall now than a bigger fall later, should it happen. It is to regard the whole action from the high in May today as a possible bear flag. Come bearish halfway hesitation type action. Now I'm the first to admit it is far from perfect, but if we look at it, we do have a possible pattern here, and with a possible target X on the downside, yes, of 337.30. Like I'd say, I'd rather look foolish now than later. Chicago soybean oil. Okay, this one has needed some major surgery upon it since last time. Gone is the recent late March to mid-May bullish Andrews pitchfork, and I've only kept the mid-January to end of March bullish Andrews pitchfork on, so you may have some idea of the scale of this move lower. Plus, as I've said for many weeks now, if this market stayed, and I quote, within this 2021 bullish Andrews pitchfork, then this market will continue to be bullish until it exits the pattern, end of quote. Well, we are out now, and it's time to look elsewhere. In addition to breaking down through the lower time, the market this week dropped down through the short medium moving average, that's currently at 60.69, congestion band 57.64 to 59.44, containing within it the August 2011 and September 2012 highs, and today simultaneously breaking a super significant support consisting of the November 2020 to date uptrend currently at 55.53, the recent 50% Fibonacci line at 55.43, and the rising medium moving average currently 55.38. All this was done with a gapping move lower today. Such action is indicative of some long-term repercussions, which is why, with 2 weeks left of June to go, I should tell you that we are on for a monthly key reversal here this month. We close on Wednesday the 30th of June either above 62.33 or below above 62.39 or below 62.33, then we'd be on. That is quite a narrow band, as you can see, and highlights last month's action as a monthly indecisive doji cross. Anyway, what's next? Well, unlike the rest of the crush, this is not a bump and run reversal top. It does not provide a suitable run in, and the bump, it's not a bump, it's a horn top. However, I am willing to extend a point in the hope of getting some idea of what is going on here. So, if we were, hypothetically you understand, to take the November 2020 to date uptrend as a trend line for a supposed bump and run reversal top, then theoretically we could see a move down to the 48.85 area. I'm not comfortable in doing that at all, which is why I'm not marking a target X on the daily chart. However, if you should look at the 48.85 area, you would see a line across the chart, the 50% Fibonacci line of the big 2008-2015 move. It just seems appropriate that a big support level would be there. Yet, and it is a big yet, there is a lot in the way before we should get down there, notably the congestion of the halfway hesitation from March and April between 51.26 and 55.43. and which we already started to probe today. That's housing within it the February 2013 high at 53.96 and the March 2013 high at 51.26. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.